One Up on Wall Street by Peter Lynch, book summary in English. Hey everyone, and welcome back to Power Books. If you're tuning in to gain an edge in the markets, unlock financial wisdom, and build lasting wealth through smart investing strategies, you are absolutely in the right place. Have you ever felt like Wall Street professionals have an unfair advantage, leaving the average investor behind? Or perhaps you've wondered if your everyday observations could actually be your secret weapon in the stock market. Well, get ready for some game-changing insights. Today on Power Books, we're diving deep into an undisputed classic, One Up on Wall Street by the legendary Peter Lynch. As one of the most successful mutual fund managers of all time, Lynch didn't just beat the market. He passionately argued that individual investors like you and me possess inherent advantages to do the same. This book isn't just theory, it's a practical blueprint showing you how to spot those elusive Tenbagger stocks right in your local community, how to avoid the common pitfalls, and master the art of long-term investing. Are you ready to discover how your common sense can lead to uncommon returns? So if you're eager to empower your financial journey, hit that like button, subscribe to Power Books if you haven't already, and let's unlock the wisdom of Peter Lynch. Introduction: an important new era for the small investor. Peter Lynch sets the stage for his groundbreaking philosophy, immediately challenging the common belief that individual investors are at a disadvantage compared to Wall Street professionals. He proclaims that we are entering an important new era for the small investor, where the amateur actually has significant advantages. Lynch argues that the average person possesses an inherent edge due to their everyday experiences. As consumers, employees, and observers of various industries, individual investors encounter promising companies long before professional analysts do. He calls this your edge, suggesting that the next great investment could be found in a product you use, a store you frequent, or a service you rely on. Wall Street pros, often constrained by corporate mandates, herd mentality, and strict industry categorizations, frequently miss these early opportunities. He introduces the concept that investing is not gambling. It's a logical process of researching a company's fundamentals and understanding its growth prospects. Lynch encourages readers to shed their fears of the stock market and embrace their innate ability to spot winning businesses. This introduction serves as a powerful call to action, urging individual investors to trust their common sense, conduct their own research, and leverage their everyday observations to outperform the so-called experts. Part 1: Preparing to be a stock picker. Chapter 1: The Advantages of Being an Amateur. In this chapter, Peter Lynch immediately drives home his core thesis. The individual investor, or amateur, possesses inherent and often underestimated advantages over the Wall Street professional. This chapter is a direct counter to the widespread belief that one needs sophisticated financial training or access to exclusive information to succeed in the stock market. Lynch passionately argues that this perception is a myth, largely perpetuated by the financial industry itself. He explains that professional fund managers face significant constraints that individual investors do not. These include herding tendencies. Professionals often follow the crowd to avoid standing out if a pick goes wrong. It's safer to fail conventionally than to succeed unconventionally. Investment mandates. Funds are often restricted to investing only in certain types or sizes of companies or within specific industries, regardless of where the best opportunities lie. Pressure to diversify excessively. While diversification is good, professionals sometimes over-diversify to the point of diluting their best ideas simply to reduce career risk. Lack of direct experience. Professionals are often stuck in offices, analyzing numbers, while amateurs are out in the real world, interacting with products and services that could be future stock winners. Lynch asserts that the edge of the amateur comes from their everyday observations and experiences. A teacher might notice a revolutionary educational product, a doctor a breakthrough medical device, or a parent a rapidly growing consumer brand. These scoops are often recognized by ordinary people long before analysts who are focused on existing industry giants catch on. He encourages readers to trust their intuition derived from personal knowledge and to avoid blindly following professional advice. Key takeaways. 1. Your greatest asset is your everyday experience. The most crucial advantage an individual investor has is their personal knowledge and observation of products, services, and trends in their daily lives. Wall Street professionals face built-in disadvantages. Due to their job constraints, mandates, and herd mentality, pros are often slower to identify and act on promising emerging companies compared to astute amateurs. 3. Investing is not a game for experts only. Lynch debunks the myth that superior returns require advanced financial degrees or exclusive information. Common sense and diligent research based on real-world experience are often more valuable. 4. Trust your common sense. Don't be intimidated by experts. If you use a product or service and believe in it, that's a valid starting point for investment research. Look for scoops in your own backyard. The next great investment idea might be right under your nose, in your shopping habits, your workplace, or your community. Chapter 2, The Earmarks of a Winner, the Perfect Stock. In this chapter, Peter Lynch dives into the qualities he looks for when identifying a truly promising investment, what he calls the perfect stock. He immediately dispels the notion that a perfect stock is always a high-tech, fast-growing company. Instead, Lynch often champions businesses that are boring, simple, easy to understand, and even somewhat disagreeable to institutional investors. His philosophy here is rooted in the idea that if a business is complex, hard to analyze, or in a trendy, highly competitive industry, its potential may already be fully priced into the stock. Lynch favors companies with several key characteristics. He loves a boring name or business, as this tends to keep Wall Street analysts away, allowing the individual investor to discover undervalued opportunities. He also seeks out companies that do something disagreeable, like waste management or funeral services, because these often face less competition. Another preferred trade is a business that doesn't need to borrow money. It can finance its growth internally. Furthermore, he looks for companies that are not dependent on a single big customer, and those with a sustainable competitive advantage, often referred to as a moat. This could be a unique product, a strong brand, a patent, or a specific market niche. He also highlights businesses that are beneficiaries of new technology, but are not directly in the high-risk tech sector themselves. Example, a company making labels for microchips, not the microchips themselves. Finally, he appreciates companies that buy back their own shares, as this demonstrates management's confidence in the business and increases earnings per share. Key takeaways. 1. The ideal stock often belongs to a boring, mundane, or even disagreeable business that professionals tend to overlook, giving individual investors an edge. 2. Look for companies with a simple business model that you can easily understand, avoiding those with overly complex or opaque operations. Seek out companies that have little to no debt and can fund their expansion from their own cash flow, indicating strong financial health. 4. Identify businesses with a sustainable competitive advantage, a moat, that protects them from rivals, ensuring long-term profitability. 5. Favor companies that are not reliant on a single, dominant customer, diversifying their revenue streams for stability. 6. Consider businesses that are benefiting from new technology without directly participating in the high-risk technology sector itself. 7. A strong indicator of management's confidence and shareholder value is a company that buys back its own shares. Chapter 3, Stalking the Tenbagger. In this chapter, Peter Lynch introduces one of his most famous concepts, the Tenbagger. This term, borrowed from baseball, refers to a stock that appreciates tenfold or 1,000% from its initial purchase price. Lynch emphasizes that finding just a few tenbaggers throughout an investing career can significantly outperform a diversified portfolio of average stocks. He argues that the pursuit of these exceptional performers is what truly drives outstanding investment returns. Lynch explains that tenbaggers aren't always found in glamorous, well-known companies. In fact, many of them come from small, overlooked, or even struggling companies that possess hidden potential. He reiterates the amateur's advantage here, as smaller companies are less likely to be covered by Wall Street analysts, allowing individual investors to discover them early. Lynch encourages investors to be constantly on the lookout for these opportunities, whether through everyday observations, reading annual reports, or exploring industries they understand. He stresses that identifying a potential ten-bagger requires more than just a good story. It demands thorough research into the company's financials, its competitive landscape, and its growth prospects. He also warns against selling a ten-bagger too early, as holding on to these long-term winners is crucial for maximizing returns, even if they experience temporary setbacks. Key takeaways. 1. The primary goal of an investor should be to find ten-baggers, stocks that can appreciate tenfold, as these few winners account for the vast majority of investment returns. 2. Ten-baggers are often found in smaller, less followed, or overlooked companies, where individual investors have a significant research advantage over institutional investors. Identifying a potential ten-bagger requires diligent research into the company's fundamentals, competitive position, and future growth potential, not just a compelling story. 4. It's crucial not to sell a ten-bagger too early, as holding on to these long-term winners is key to realizing their full potential, even through market volatility. 5. Every investor should be constantly searching for these extraordinary opportunities by leveraging their everyday experiences and observations. Chapter 4. The Best Place to Look, From Stores to Scoops. In this chapter, Peter Lynch provides practical guidance on where to find promising investment ideas, emphasizing that the best sources are often right under an individual investor's nose, far from the bustling offices of Wall Street. He reiterates his belief that the amateur's edge comes from everyday observations and experiences. Lynch suggests that a great stock idea can originate from places like retail stores you frequent, products you use, services you subscribe to, or even within your own workplace. He encourages investors to pay attention to trends and companies that are doing well in their local communities or within industries they understand personally. This could mean noticing a new, popular product flying off shelves, a restaurant chain with consistently long lines, or a company at your job that is gaining market share. These are the scoops that individual investors can get long before professional analysts, who are often focused on large-cap, well-established companies, take notice. Lynch also advises looking at companies that benefit from a niche, a demographic trend, or those experiencing significant growth in an unglamorous industry. The key is to be an active, curious observer of the world around you, always on the lookout for businesses that are thriving and have room to grow. Key takeaways. 1. Excellent investment ideas frequently originate from everyday life experiences, such as shopping, using new products, or observing workplace trends. 2. Individual investors gain a significant advantage by discovering scoops, promising companies, early before they capture the attention of Wall Street professionals. 3. Pay close attention to businesses that are thriving locally or within industries you are personally familiar with. 4. Look for companies that benefit from demographic shifts, niche markets, or growth in overlooked, unglamorous industries. 5. Cultivate a mindset of constant observation and curiosity about the world, treating your daily life as a rich source of potential investment opportunities. Chapter 5. The Worst Stocks to Own. In this chapter, Peter Lynch shifts gears from identifying winners to warning against the types of stocks that are most likely to disappoint or lead to significant losses. He outlines several categories of companies and prevailing market conditions that he considers to be the worst stocks to own, urging investors to avoid them, regardless of popular opinion or temporary hype. Lynch emphasizes that understanding what not to buy is just as crucial, if not more so, than knowing what to buy. He begins by cautioning against hot stocks in hot industries. These are often companies in trendy sectors like, in his time, biotechnology or high-tech fads that capture public imagination, leading to inflated expectations and overvalued stock prices. Lynch argues that while the underlying industry might be revolutionary, it's often impossible to pick long-term winners among a sea of competitors, and many will fail. He also advises avoiding companies that are lauded as the next something, e.g. the next IBM or the next Microsoft, as these rarely live up to the hype and simply indicate a lack of original thought. Another red flag is the whisper stock, a supposedly secret tip about an amazing company that's about to explode, often spread by amateurs. He also warns against middlemen or suppliers whose fortunes are entirely dependent on a single powerful customer, as they lack pricing power and are vulnerable to that customer's whims. Finally, Lynch expresses deep skepticism about diversifications, companies that acquire businesses in completely unrelated fields, often destroying shareholder value by entering areas they don't understand. Key takeaways. 1. Avoid hot stocks in hot industries as they are often overvalued and competitive pressures make it difficult for any single company to sustain long-term success. 2. Be wary of companies promoted as the next famous successful company, as such claims usually indicate hype rather than fundamental strength or a unique competitive edge. 3. Steer clear of whisper stocks and supposed secret tips, as they lack fundamental research and are prone to being pump-and-dump schemes or based on rumor. 4. Be cautious with suppliers or middlemen heavily dependent on a single major customer, as their profitability and survival are too vulnerable to external forces. 5. Shun companies engaging in diversifications, which are ill-advised acquisitions of unrelated businesses that often destroy shareholder value and indicate management lacking focus. Chapter 6: The Perfect Company. In this chapter, Peter Lynch synthesizes his earlier points to describe the ideal characteristics of what he considers the perfect company from an investment perspective. While he acknowledges that no company is truly flawless, he outlines a set of attributes that significantly increase a stock's potential for being a multi-bagger. This chapter serves as a counterpoint to the previous one, providing a positive template of what to look for after identifying what to avoid. Lynch starts by emphasizing companies with a boring name or business, a trait he consistently champions because it typically means Wall Street analysts overlook them, leaving them undervalued. He also loves businesses that do something disagreeable or depressing, like hazardous waste disposal or debt collection, as these often face less competition and can maintain strong profit margins. Another key characteristic is a company that doesn't need to borrow money. It generates enough cash internally to fund its growth, signifying robust financial health and independence. He highly values companies that buy back their own shares, especially when undervalued, seeing it as a strong vote of confidence from management and a direct way to boost shareholder value. Businesses with strong competitive advantages, or moats, such as unique products, patents, powerful brand recognition, or a dominant market niche, are also favored. Lastly, he often looks for companies that are beneficiaries of new technology but are not directly in the risky, highly competitive technology sector themselves. Such companies provide essential components or services to the booming tech industry without facing the same high-stakes innovation race. Key takeaways. 1. An ideal investment often involves a company with a boring or unglamorous name or business, as these tend to be overlooked and undervalued by the broader market. 2. Look for companies engaged in disagreeable or depressing activities that deter competitors, potentially leading to stable, high-margin operations. 3. Favor companies with strong balance sheets that don't rely on debt for growth, demonstrating financial self-sufficiency and stability. 4. Prioritize businesses that consistently buy back their own stock, a clear signal of management's belief in the company's value and commitment to shareholders. 5. Seek out companies possessing a sustainable competitive advantage that protects their market position and profitability from rivals. 6. Identify businesses that indirectly benefit from technological advancements by supplying necessary components or services, rather than being directly in the volatile tech sector. Chapter 7: Company Name Games. In this chapter, Peter Lynch humorously, yet insightfully, delves into the peculiar relationship between a company's name, or its industry's perception, and its investment potential. He argues that the less glamorous or more unappealing a company's name or business sounds, the better it might be as an investment. This chapter expands on his earlier theme that boring companies are often overlooked by Wall Street professionals, creating opportunities for astute individual investors. Lynch explains that exciting, high-tech or trendy company names and industries tend to attract a lot of attention, driving up stock prices and often leading to overvaluation. Conversely, businesses with names that are dull, confusing, or even slightly off-putting, like names with a tron or data suffix that became dated quickly in his era, are rarely the subject of analyst reports or enthusiastic media coverage. This lack of attention allows these companies to grow steadily and remain undervalued for longer. He cites examples of companies involved in unglamorous but essential businesses, like waste management or funeral services, which consistently generate strong cash flows and are rarely subject to fads. The core message is to look beyond the superficial appeal of a name and dig into the actual business fundamentals. A company with a fantastic-sounding product or a cutting-edge name might simply be marketing hype, while a prosaic-sounding business could be a hidden gem. Key takeaways. 1. Companies with boring, unappealing, or even slightly confusing names are often excellent investment candidates because they tend to be ignored by the broader market and Wall Street. 2. Avoid investing in companies solely based on their trendy or exciting names, as these often attract excessive attention and can lead to overvalued stocks. 3. Focus on the underlying business fundamentals rather than the superficial appeal of a company's name or its industry's sexiness. 4. The less analysts and the public are interested in a company's name or industry, the greater the chance for an individual investor to find an undervalued opportunity. 5. True investment gems are often found in mundane or unglamorous sectors that consistently generate profits without media fanfare. Part 2, Picking Winners. Chapter 8, Sizing Up the Situation. In this chapter, Peter Lynch transitions from the mindset and general characteristics of good companies to the practical art of categorizing and analyzing stocks. He emphasizes that not all companies or their stocks behave the same way, and understanding their underlying type is crucial for setting realistic expectations and deciding when to buy or sell. Lynch presents his system of 6 basic categories of stocks, arguing that each requires a different analytical approach and investment strategy. These categories are: 1. Slow growers, large, old companies that grow only slightly faster than the economy. They usually pay regular dividends. Lynch sees them as less exciting but potentially stable, though not where you'll find Tenbaggers. Stalwarts, large companies that can still grow 10 to 12% per year. These are often Lynch's favorites for stability during recessions, as they provide consistent returns. Examples might be Coca-Cola or Procter & Gamble. Fast growers, small aggressive new companies growing at 20-25% a year. These are Lynch's prime hunting ground for multi-baggers, but they come with higher risk. Careful selection is vital. 4. Cyclicals, companies whose sales and profits rise and fall in predictable, though not perfectly timed cycles, often tied to the economy or commodity prices. Examples include auto manufacturers, airlines, or chemical companies. Timing entry and exit is paramount for cyclicals. 5. Asset plays, companies that own valuable assets like land, patents, or cash that are not widely recognized or are undervalued by the market. The stock price often doesn't reflect the true value of these underlying assets. 6. Turnarounds, companies that are struggling or near bankruptcy but have the potential to recover. These are risky, but successful turnarounds can offer huge returns if the recovery efforts succeed. Lynch stresses that investors must correctly identify which category a stock falls into because the reasons to own it, the way to monitor it, and the timing for selling it differ dramatically for each type. For instance, you don't buy a cyclical for consistent long-term growth, and you don't buy a fast grower for dividend income. Key takeaways. 1. Successfully picking stocks requires understanding that different companies belong to different categories, and each category behaves uniquely. 2. Lynch identifies 6 main stock categories: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. 3. Each stock category demands a distinct investment strategy regarding research, expected growth rates, risk tolerance, and optimal buy-sell timing. 4. Fast growers are where Lynch found most of his Tenbaggers, but they require careful diligence due to higher inherent risk. 5. Cyclicals demand precise timing. Buying and selling at the wrong point in their cycle can lead to significant losses. 6. Asset plays require digging deep into a company's balance sheet to uncover hidden value not reflected in the stock price. Turnarounds are high-risk, high-reward plays that depend entirely on the company's ability to execute a successful recovery plan. Chapter 9. The 12 Slogans, Things to Remember About Stocks. In this chapter, Peter Lynch distills much of his accumulated wisdom into 12 concise slogans or maxims designed to serve as guiding principles for individual investors. These aren't rigid rules, but rather practical reminders of common pitfalls to avoid and crucial insights to embrace when navigating the stock market. This chapter reinforces many themes introduced earlier while adding new perspectives on market psychology and long-term thinking. Lynch covers a wide range of advice. He begins by reminding investors that it's impossible to predict the economy or interest rates, so focus on individual companies. He cautions against overpaying for even a great company and emphasizes that investing in local, familiar companies can be a significant advantage. He stresses that earnings drive stock prices in the long run and that you should know what you own and why you own it. Lynch also highlights the importance of patience and allowing winners to run, noting that frequently trading in and out of positions often reduces returns. He debunks the idea of getting rich quick and warns against relying on charts alone without understanding the underlying business. He also includes reminders about the danger of over-diversification, the tendency of good companies to eventually face challenges, and the continuous need for reevaluation of your holdings. The overarching message is to approach investing with common sense, thorough research, and a long-term perspective. Key takeaways: the slogans. 1. It's fool's errand to predict the direction of the economy or interest rates. Focus instead on the specific companies. 2. Never invest in any company before you've done your homework on its fundamentals. 3. You can make money with a stock even if you don't understand the technology. Understanding the business is what matters. 4. It's usually futile to speculate on the movement of the overall market. Individual stock selection is key. Investing in local, familiar companies can give you an immediate and often powerful informational edge. 6. The stock market is a game of patience. Successful investing is a marathon, not a sprint. 7. Earnings drive stock prices. A company's ability to grow its profits is the ultimate determinant of its stock's long-term performance. 8. Know what you own and why you own it. If you can't explain it simply, you shouldn't own it. 9. Don't fall in love with a stock. Be prepared to sell if the fundamentals deteriorate or a better opportunity arises. Never buy a stock based on a tip without independent research. Tips are often based on rumor, not reality. 11. The biggest gains come from allowing winners to run. Cutting winners short is a common mistake. 12. The worst mistake is to diversify so much that you own mediocre companies that you can't effectively monitor. Chapter 10. Getting the facts, checking the facts. In this chapter, Peter Lynch shifts his focus to the crucial process of due diligence, how to gather and verify the necessary information about a company before investing. He emphasizes that while the amateur's edge is powerful, it must be supported by diligent research, not just intuition. Lynch provides practical advice on where to find reliable data and how to interpret it, underscoring that thorough investigation significantly reduces risk and increases the chances of successful investing. He begins by highlighting that annual reports are a treasure trove of information. Despite their often dry presentation, Lynch advises investors to read them carefully, paying particular attention to the footnotes, which can reveal hidden details about debt, liabilities, and accounting practices. He also suggests looking at 10K and 10Q filings for U.S. publicly traded companies, which are even more detailed and often more honest than the glossy annual reports. Beyond financial documents, Lynch advocates using everyday resources like newspapers, magazines, and trade journals to stay informed about industries and competitors. He also encourages investors to kick the tires, visit stores, talk to employees, or even call the company directly to get a sense of its operations and management. His key message is to be skeptical, cross-reference information, and never rely solely on brokerage reports or analyst recommendations, which often have inherent biases. Key takeaways. 1. Successful investing demands diligent research and fact-checking beyond initial impressions, as intuition alone is insufficient for long-term success. 2. Annual reports are invaluable resources. Pay particular attention to the footnotes for critical details that might be hidden in the main text. 3. Utilize more detailed regulatory filings like 10K and 10Q reports for a deeper and more objective understanding of a company's financial health. 4. Expand your research beyond official documents by reading industry publications, news articles, and even by directly observing or interacting with the company's products, services, or locations. 5. Always maintain a healthy skepticism and cross-reference information from various sources, especially when dealing with analyst reports or brokerage recommendations, which can be biased. Chapter 11. Visiting the Company. In this chapter, Peter Lynch takes the concept of getting the facts a step further by advocating for what he calls kicking the tires, that is, directly visiting or interacting with the company you're considering investing in. While he acknowledges that not every investor can visit corporate headquarters, he stresses the value of first-hand observation and informal inquiry. This approach moves beyond just looking at financial statements and into understanding the actual operations and morale of a business. Lynch suggests various ways to visit a company, even without a formal tour. This could involve visiting their stores or service centers to observe customer traffic, product appeal, and employee attitudes. He recommends talking to employees, especially lower-level ones, to gauge morale, efficiency, and management effectiveness. He also suggests calling the company's investor relations department with specific, well-researched questions, or even speaking with competitors or suppliers to get a fuller picture. The goal is to gain qualitative insights that numbers alone can't provide. Lynch warns against being swayed by fancy presentations or a CEO's charisma. Instead, focus on concrete details about the business operations, cost structure, and future plans. He emphasizes that the best information often comes from these informal, real-world checks, which again leverage the amateur's advantage over distant analysts. Key takeaways. 1. Go beyond financial statements by actively observing and interacting with the company's operations in the real world. 2. Visit stores, service centers, or facilities to assess customer engagement, product quality, and overall business activity. 3. Talk to employees, particularly those on the ground, to gain insights into morale, operational efficiency, and the effectiveness of management. 4. Don't hesitate to contact investor relations with specific questions or even speak with competitors or suppliers for a broader perspective. Focus on gathering concrete, qualitative information about the business rather than being swayed by superficial presentations or corporate hype. Chapter 12. The Pros and Cons of Long Shots. In this chapter, Peter Lynch delves into the nuances of investing in long shots, companies that have the potential for explosive growth, but also come with significant risks. He doesn't dismiss them outright, but provides a balanced view, explaining when and how to approach these high-stakes investments, distinguishing them from pure gambles. Lynch emphasizes that while long shots can deliver multi-bagger returns, they require extra scrutiny and a clear understanding of the underlying business story. Lynch categorizes long shots, differentiating between those that are pure speculation, like a gold exploration company with no gold found yet, or a biotech firm with no FDA-approved drugs, and those that have a real chance of success based on tangible developments. He advises investors to focus on companies where the long shot status is tied to a specific, identifiable catalyst, such as a pending FDA approval for a drug, a new technology gaining traction, or a natural resource company finally hitting a big find. He cautions against investing in long shots that are merely conceptual or based on dreams, without any concrete progress. The key is to verify if the company is actually moving towards its goal and has sufficient funding to get there. Lynch also stresses the importance of proper position sizing for long shots. Even if one pays off big, a portfolio shouldn't be dominated by these highly speculative ventures. as many will inevitably fail. Key takeaways. 1. Not all long shots are mere gambles. Some present high-risk, high-reward opportunities that can significantly boost portfolio returns. 2. Differentiate between speculative long shots based purely on hope and those with a clear, identifiable catalyst that could fundamentally change the business. 3. Thoroughly research the specific catalyst driving the long shot's potential, such as regulatory approvals, technological breakthroughs, or confirmed resource discoveries. Verify that the company has sufficient financial resources to execute its plan and reach the point where the long shot might pay off. 5. Maintain appropriate position sizing. While exciting, long shots should only constitute a small, manageable portion of your overall investment portfolio due to their inherent failure rate. Chapter 13, The Dreaded Phone Call. In this chapter, Peter Lynch humorously, yet pointedly, addresses a common scenario for individual investors: the impulsive, ill-advised phone call to a broker to sell a stock. This chapter serves as a critical lesson in maintaining emotional discipline and avoiding rash decisions driven by fear, rumor, or panic. Lynch argues that such dreaded phone calls often lead to investors selling their best long-term prospects right at the worst possible time, cutting off future gains. Lynch explains that investors often make these calls when a stock they own experiences a temporary dip, when they hear negative news, or when they feel overwhelmed by market volatility. He highlights how easy it is to be spooked by short-term fluctuations or pessimistic forecasts from the media or even friends. He emphasizes that the primary reason to sell a stock should be a deterioration in the company's fundamentals, not market noise or emotional reactions. Lynch recounts instances where he or others almost made such a dreaded call, only to regret it deeply later when the underlying business recovered and thrived. He stresses that volatility is normal, and strong companies can weather temporary storms. The chapter is a powerful reminder that patience and conviction based on thorough research are far more valuable than reacting to every hiccup. Key takeaways. 1. Avoid making impulsive decisions to sell stocks based on short-term price drops, market rumors, or general panic. 2. The only valid reason to sell a stock is a fundamental deterioration of the company's business, not temporary market volatility or external noise. 3. Be wary of the dreaded phone call to your broker, as it often results in selling good companies at inopportune times, cutting off potential long-term gains. 4. Patience and a strong conviction in your research are crucial for riding out market fluctuations and allowing your investments to mature. 5. Market volatility is normal and should be expected. It does not inherently mean a fundamentally sound company has become a bad investment. Chapter 14, The Final Checklist. In this pivotal chapter, Peter Lynch provides a comprehensive final checklist of criteria he uses to evaluate a stock before making an investment. This serves as a practical distillation of all the lessons learned throughout the previous chapters, offering investors a systematic way to assess a company's investment potential. It's designed to ensure that even with an exciting story, the underlying business fundamentals are solid. Lynch divides his checklist into categories, reinforcing that different types of stocks, as discussed in Chapter 8, require different analytical focuses. For all stocks, he emphasizes checking the price-to-earnings P ratio relative to its historical average and its industry, confirming the company's financial strength, debt, cash flow, and understanding management strategy. For fast growers, he focuses on verifying consistent earnings growth, the ability to expand into new markets, and whether they have a strong balance sheet to support expansion. For stalwarts, the key is consistent growth, dividend reliability, and the potential for new products to reignite growth. Cyclicals demand an understanding of inventory levels, supply-demand dynamics, and the timing of economic cycles. For asset plays, the focus is on identifying undervalued assets, real estate, patents, cash, and understanding what could unlock their value. Finally, for turnarounds, he stresses the importance of clearly defined recovery plans, cost-cutting measures, and whether there's a strong management team executing the turnaround. The chapter underscores that investing isn't about guesswork, but about diligent, focused research, tailored to the specific company. Key takeaways. 1. Before investing, always use a comprehensive checklist to systematically evaluate a company's fundamental health and investment prospects. 2. Tailor your checklist questions to the specific category of stock you are analyzing, e.g., fast grower, cyclical, turnaround, as each requires different points of focus. 3. For any stock, essential checks include the PE ratio, debt levels, cash flow, and clear understanding of management's strategy and their commitment to share buybacks. 4. For growing companies, verify the consistency of their earnings growth, their ability to expand into new markets, and their strong financial position. 5. When considering cyclical stocks, deeply understand the inventory levels, industry capacity, and where the company stands within its current cycle. 6. For asset plays, focus on identifying hidden or undervalued assets on the balance sheet and understanding how their value might be realized. 7. In turnaround situations, assess the viability of the recovery plan, the effectiveness of cost cutting, and the strength of the management team leading the change. Part 3, the long term. Chapter 15, putting it all together. In this crucial chapter, Peter Lynch shifts from individual stock selection to the broader challenges and rewards of managing a portfolio over the long term. He emphasizes that even after picking great stocks, success hinges on an investor's ability to remain disciplined, resist emotional reactions, and continuously monitor their investments. This chapter is about moving beyond simply picking winners to the art of successful portfolio management and navigating the inherent volatility of the stock market. Lynch reminds investors that stocks do not always go up in a straight line, even the best ones. Temporary dips, market corrections, and even recessions are normal and expected parts of the investing landscape. He advises against panic selling during downturns, reiterating that true long-term gains are realized by holding on to fundamentally strong companies through cycles. He discusses the importance of periodically reviewing your portfolio to ensure that your reasons for owning each stock still hold true and that their fundamentals haven't deteriorated. He also touches on the concept of rebalancing, but warns against excessive trading, as transaction costs and short-term capital gains taxes can significantly erode returns. The core message is that patience, a long-term perspective, and the ability to ignore market noise are just as vital as the initial research in achieving superior investment results. Investing, Lynch concludes, is less about precise timing and more about understanding the underlying businesses and allowing their value to compound over time. Key takeaways. 1. Successful long-term investing requires discipline and emotional control as market volatility and temporary setbacks are inevitable. 2. Do not panic sell during market downturns or corrections. These are often opportunities to buy more of fundamentally strong companies. 3. Regularly review your portfolio to confirm that the original reasons for owning each stock remain valid and that the company's fundamentals are still strong. 4. Avoid excessive trading or frequent rebalancing, as transaction costs and taxes can significantly diminish your overall returns. 5. True wealth in the stock market is built through patience and allowing the value of good businesses to compound over many years, rather than trying to time market fluctuations. Chapter 16, The Art of Selling. In this chapter, Peter Lynch tackles one of the most challenging aspects of investing, knowing when to sell a stock. He asserts that buying well is only half the battle. Selling wisely is equally crucial for maximizing returns and avoiding unnecessary losses. Lynch provides distinct reasons to sell based on the type of stock and the changes in its underlying fundamentals, dispelling common but often detrimental selling myths. Lynch outlines several scenarios that typically warrant selling. For fast growers, the primary reason to sell is often when their growth rate significantly slows down, example, from 25% to 10%, or when they begin to lose market share, indicating saturation or increased competition. For stalwarts, a sell signal might be when they become overvalued relative to their earnings growth, or when they start diversifying poorly. With cyclicals, the key is to sell when the industry cycle is peaking. Example, high inventories, new competitors entering, long before the general public recognizes the top. turnarounds should be sold once the turnaround has been successfully executed and the stock price reflects this recovery, or if the recovery plan completely falls apart. For asset plays, you sell when the assets are recognized and fully valued by the market. Lynch strongly advises against selling simply because a stock has gone up a certain percentage, or because you need the money for a trivial purchase, or because the market as a whole is volatile. The decision to sell should always be based on a deterioration of the company's story or fundamentals, not external noise or arbitrary price targets. 1. Knowing when to sell a stock is as critical as knowing when to buy, and often more difficult due to emotional biases. 2. The decision to sell should primarily be driven by a deterioration in the company's fundamental story or its prospects, rather than arbitrary price targets or market fluctuations. For fast growers, sell when their growth rate slows dramatically or they lose their competitive edge. 4. For cyclicals, sell near the peak of their industry cycle, anticipating the inevitable downturn, often when news seems best. 5. Turnarounds should be sold once their recovery plan is successful and fully priced in, or if the plan unequivocally fails. 6. Avoid common selling mistakes like selling just because a stock has doubled, or because you need cash for non-essential items, or due to market noise. Resist the urge to sell winners too early. Let your profitable investments continue to compound unless their underlying story changes for the worse. Chapter 17, The 6-Month Shibboleth. In this chapter, Peter Lynch directly challenges a common, yet often detrimental misconception among investors: the idea that there's a particular, magical time frame, like 6 months, after which one should evaluate or sell a stock. He dubs this the 6-month Shibboleth, a belief or custom that's widely accepted, but ultimately unhelpful and often counterproductive. Lynch argues that focusing on arbitrary timeframes rather than on a company's fundamental performance is a major reason why many investors fail to realize significant gains. Lynch explains that companies don't operate on a 6-month or even a 1-year calendar for their growth cycles. Business developments, strategic initiatives, and market recognition can take years to unfold. Selling a stock simply because it hasn't performed within a short, arbitrary period means missing out on the compounding power of long-term investments. He emphasizes that the market's perception of a company can be slow to catch up to its actual fundamental improvements. Therefore, patience is paramount. The only valid reason to sell a stock, as he reiterated in Chapter 16, remains a deterioration of its underlying business or a fundamental change in its story, not a predetermined calendar date. Lynch encourages investors to view their stock purchases as ownership in a business and to hold them as long as the business continues to thrive, regardless of short-term market noise or artificial deadlines. Key takeaways. 1. Disregard the common misconception that stocks should be evaluated or sold after an arbitrary time frame, such as 6 months. This is a shibboleth that often harms returns. 2. Companies and their growth stories unfold over years, not months, and imposing short-term deadlines on your investments can lead to missing out on significant long-term gains. The market's recognition of a company's fundamental improvements can be slow, so patience is a virtue that allows good businesses to compound value over time. 4. The decision to sell a stock should always be based on a deterioration of the company's fundamentals or its long-term prospects, never on a calendar. 5. View your stock investments as owning a piece of a business and hold on to them as long as the underlying business continues to perform well, ignoring short-term market noise. Chapter 18, The 12 Slogans Revisited. In this chapter, Peter Lynch circles back to his 12 slogans, originally introduced in Chapter 9, revisiting them with the added weight of practical application and reiterating their enduring importance. Having taken the reader through the nuances of picking stocks, researching companies, and understanding market behavior, Lynch uses this chapter to reinforce these core principles as a constant guide for investors navigating the complexities of the stock market. It serves as a potent reminder that while detailed analysis is crucial, adhering to fundamental common sense rules is what ultimately leads to long-term success. Lynch doesn't just repeat the slogans, he often elaborates on why they are so vital, providing further context or examples based on the subsequent discussions in the book. He underscores that these slogans are not theoretical concepts, but practical truths derived from decades of experience. For example, he re-emphasizes that it's impossible to predict the economy or interest rates, so focus on individual companies. He reminds investors to know what they own, stressing that a deep understanding of the business is paramount. The importance of patience and letting winners run is reinforced, countering the urge to sell too early. He also re-emphasizes the dangers of hot stocks and the wisdom of investing in boring companies. The chapter's essence is that successful investing is a blend of diligent research, realistic expectations, and emotional discipline, all encapsulated by these fundamental principles. They are the fixed points in a constantly moving market. Key takeaways. 1. Reaffirm your belief that economic and interest rate predictions are unreliable for successful long-term investing. Focus on business fundamentals. 2. Always conduct thorough homework on any company before committing your capital. 3. Remember that understanding the business itself is far more critical than comprehending its complex technology. 4. Accept that speculating on overall market movements is unproductive. Individual stock selection is the path to returns. 5. Leverage your natural informational advantage by investigating companies in your daily life and local environment. 6. Cultivate patience as a virtue. Significant gains accrue over time, not overnight. 7. Never forget that earnings growth is the primary driver of stock prices in the long run. 8. Always be able to articulate precisely why you own a stock and what you expect from it. 9. Avoid emotional attachment to any stock. Be prepared to sell if the fundamental story changes for the worse. Dismiss unresearched tips and focus on your own due diligence. 11. Allow your successful investments to grow to their full potential. Cutting winners short limits your overall returns. 12. Be mindful of over-diversification that leads to owning too many mediocre companies you cannot effectively monitor. Chapter 19, The Best Time to Buy and Sell. In this concluding chapter, Peter Lynch tackles the perennial question that plagues every investor. When is the absolute best time to buy and sell stocks? His answer, consistent with his overall philosophy, is that it's not about market timing, but rather about understanding the fundamental story of the individual companies you invest in. He largely dismisses the notion that investors can reliably predict market tops or bottoms, a task even most professionals fail at consistently. Lynch re-emphasizes that trying to time the market based on economic forecasts, interest rate predictions, or broad market sentiment is a losing game. Instead, he advises investors to buy good companies at reasonable prices whenever they find them, and to sell only when the company's fundamentals deteriorate or its story changes for the worse. He points out that missing the few best days in the market can drastically reduce long-term returns, and these best days often occur unexpectedly after significant drops. Therefore, staying invested in quality companies is more important than attempting to sidestep every downturn. He highlights that great companies can continue to grow and prosper even in difficult economic times, and their stock prices will eventually reflect that. The chapter reinforces the idea that patience, a long-term perspective, and a focus on the underlying business are the ultimate strategies for success, far outweighing any attempt to perfectly time market entry or exit. Key takeaways. 1. The best time to buy and sell is not about timing the overall market, which is an unreliable and often detrimental strategy. 2. Focus on buying excellent companies at fair valuations whenever you identify them, regardless of current market conditions. 3. The only valid reason to sell a stock is a significant deterioration in its fundamental business or a permanent change in its positive story. Missing even a few of the market's best-performing days can severely damage long-term returns, underscoring the importance of staying invested. 5. Patience and a steadfast focus on a company's underlying business are the most crucial factors for long-term investing success, outweighing short-term market noise. Epilogue. In the Epilogue, Peter Lynch offers his final reflections and enduring advice to the individual investor. This section isn't a new set of rules, but rather a reaffirmation of the core principles that have guided his successful career. He emphasizes that the world of investing, while constantly changing in terms of specific companies and technologies, remains fundamentally governed by the same human behaviors and business cycles. Lynch reiterates that patience, common sense, and diligent research are the ultimate virtues in investing. He encourages readers to continue cultivating their amateur's edge by observing the world around them, doing their own homework, and trusting their analysis over market gurus or fleeting trends. He stresses the importance of ignoring market noise and short-term volatility, reminding investors that trying to predict recessions or market corrections is a futile exercise. Instead, focus on the long-term prospects of the businesses you own. The Epilogue is a call to action for individual investors to take control of their financial futures, armed with the knowledge and confidence to outperform professionals by sticking to simple, proven strategies. Lynch's final message is one of empowerment. The tools for investment success are within reach of anyone willing to put in the effort and exercise sound judgment. Key takeaways. 1. The fundamental principles of investing remain timeless, despite continuous changes in specific industries or market conditions. 2. Patience, common sense, and thorough independent research are the most crucial qualities for long-term investment success. 3. Continue to leverage your everyday observations to identify promising companies, as this remains your key advantage over professionals. 4. Ignore short-term market fluctuations and economic forecasts. These are largely irrelevant to the long-term prospects of solid businesses. True investing success comes from sticking to a disciplined approach focused on understanding and holding good companies, not from timing the market. All right, PowerBooks community, that brings us to the close of another insightful exploration, this time into the brilliant world of Peter Lynch's One Up on Wall Street. I trust you've gained some truly valuable insights into how to leverage your everyday observations, spot those overlooked gems, and recognize why the individual investor truly has an edge over Wall Street professionals. If this breakdown has empowered you to approach the stock market with renewed confidence and a common sense approach to finding great companies, then let me know in the comments below. If there's enough interest, I'll be sure to include a link to the full book in the description for you to explore every nuance of Lynch's wisdom. And if this summary has equipped you with a fresh perspective on stock picking and long-term wealth building, please hit that like button to help us share this knowledge with more individuals striving for financial success. Don't forget to share this video with your friends, family, and fellow aspiring investors who are looking to gain a deeper understanding of market dynamics and company analysis. Of course, to continue fueling your journey with more powerful book summaries on self-development, success, business, motivation, trading, investing, trading psychology, wealth building, mindset, abundance, manifestation, and personal growth, make sure you subscribe to PowerBooks and ring that notification bell so you never miss our next deep dive. Your thoughts and questions are invaluable, so please comment below with your key takeaways or any aspects of One Up on Wall Street that resonated most with you. Remember, here at PowerBooks, we know that knowledge is not power. The application of knowledge is power. So take these insights, apply them to your investment strategy, and strive for that powerful success. Thanks for tuning in. Stay curious, keep learning, and we'll catch you in the next powerful book breakdown.